The Consumer Bankers Association is pleased to welcome you to today's webinar, Aligning Retail Distribution, Technology, and Workforce. It's now my pleasure to introduce today's speakers. Randy Ross is Executive Vice President at Kiran Analytics. Tom McDermott is co-founder and managing partner at Inver Consulting Group. Randy and Tom, welcome to the program. Let's get started.
Here's what we intend to cover: branch and ATM network optimization, workforce optimization, technology utilization and adoption, and this slide is just illustrating the multi-channel experience that customers prefer. And there's a whole continuum that various institutions are at, or where their customers are at, probably more accurately, around how they like to do business. One of the things I would say is and have observed is that customers have not met a channel that they don't like. But each bank is in a different place along the continuum based on adoption rates, based on your demographics, based on your own individual goals, as well as the technology you've deployed. So that's going to vary. Cost is still important. It's not maybe as overriding as it was years ago. I think what I observe is the customer experience is paramount. Then kind of alongside that, if I think about customer service and meeting financial needs is a piece of that, which you can call sales, but that's a very important part as well, as how do we meet customer needs and build loyalty. The branch is still where most consumers believe they're getting the advice and counsel they need, where they make their sales decisions, where they feel that they need that extra expertise that maybe they can't get through other channels. And so the bottom line is that branches still do matter. So when you talk about the physical network related to that, it's still critically important to your distribution strategy, your omni-channel strategy as well.
So this little grid here really just kind of outlines out a couple of key factors and a couple of different branch types. The flagship branch would be kind of your brand billboards. You wouldn't have many of those branches at all. You'd have maybe 5% of your network at most. The next one is hub. Probably should be about 35% of your network. And then going down the line, I'll go to the end one. In-store is about 10%, and the remaining should be your spoke or your micro branches, smaller formats. You can see there the different types of customer segments that I believe each one of those branch type targets. And then looking at the square footage, it corresponds to the purpose of each one of those branches. And then once again, what's that touch point objective? The large flagship, it is about that brand showcase. It's making sure that it may be a training site. It really is your profit leader, that may be your multi-million-dollar profit branch. The hub really is an area that is driving your sales and service versus your spoke, which in essence really becomes more of your digital showcase. The hub is one where if you're going to make everything a bank in a branch, for essence, then your spoke needs to be a little smaller, and therefore you can get some savings. Then the in-store, it's about really trying to build awareness with prospects. Have you really thought about a customer touchpoint strategy versus a network strategy? While branch location strategy is well defined, really the real estate and line of business partner coverages tend to be weak. So, why do you have certain partners cover certain ones? The rule that we have to have coverage in every branch has kind of been a thought process for a long time. How do you really kind of make sure that you have the customer thought process in mind based on opportunity? Second really is looking at ATMs, and I'm talking about here now the non-branch ATMs. How do you get more out there, and where should they go? And a lot of times when you're dealing with brokers, it's all about commercial relationships. ATM analytics is an area that I would argue is very immature, and a lot of times is based off of really relationships that you have either with a broker relationship or a commercial relationship. The next 2 points are really kind of getting into the video ATM. This goes both in branch and outside of branch. So where would you actually put a video ATM in a branch? And of course then, I won't get into, since we're not really talking about call centers a lot here, I just think it's important to know that the call center has emerged as being a major support for the branch. It always has been from a sales perspective or opening up the account process perspective, but it now is becoming a bigger part as you start to look at the different technology that's inside of a branch. Where does the call center play into that? So we get into kind of formats a little bit, and this is one where we have some pretty interesting examples here. I know, Randy, you have one that you'd love to talk about, so I'll let you kind of maybe jump in here a little bit too.
The one I'm going to point out is down here in the lower right-hand corner with PNC's little mobile pop-up branch. I've seen lots of articles and discussion about that. But if I think about PNC's network, they've got 2,000 plus branches, and they have one of these. and they've had one of them for the last 3, 4, 5 years. There's value, and they might get a lot of publicity and press. Data says that some of these formats work in a very narrow niche and maybe are not that profitable overall. Often I see a lot of hype in the press around some of these things that don't connect to the reality of what the data says around the kind of results that they're generating.
Yeah, I agree with you 100%. I think, one branch is not necessarily success. Success or failure is back into, are you able to roll it out into more than just one particular branch? I've closed over 500 branches in my career, and I've opened up over 500 branches. So I know a thing or two about branch closures. Over 90% of branches with less than 25 million have been in closure. And the reason why is just with the technology, and it's just too expensive if you can't have the right level deposits. I could talk all day about the expense side and why people do it. And in general, I'd say 60 to 80% of the closing branches expenses, they are cost saved to the bank, or at least a portion of that. But the bigger thing that I found really interesting has been around the revenue side, and very few people talk about this because they just don't look at the numbers. But when you look at the numbers of all the incremental revenue, while you do keep 85 to 95% of the deposits in households, but 85 to 95% go to a receiving branch. And then on the other side of it, though, the incremental revenue that leaves. So once you leave a particular micro market, 90% of the revenue really goes to the competitors. So the receiving branch only captures about 10% of the incremental revenue when a branch closes, and that's pretty upsetting. And so I thought this is a really important fact to kind of get across. Is a lot of times when branches are being closed, it's done for cost savings purposes. However, the lost revenue is a really big issue, and generally the incremental revenue goes to your favorite competitor down the street. So something to really pay attention to.
Traditionally, the approach around operating hours tends to focus on teller transactions. It looks at low transaction volume branches driven by often subjective treatment of one or two factors, such as a branch format or competitive operating hours. There's often assumptions around all hours are the same within each location, and it views each branch in isolation. And you end up often taking one-size-fits-all approaches that are, again, focused on reducing costs and not looking more holistically. So where we would encourage your thinking around this when you're looking at adjusting your operating hours within your branch network is think about the relationship between sales and open hours. We are an analytics company. We've seen organizations that have 200 plus different operating hour scenarios across their branch network. So there is a place for simplification around that. We do an annual survey around workforce management, and these are the top 5 things that came out. 70% of the banks that we had responses from said aligning solid capacity to market opportunity was their number one goal. The second was around deploying universal banking. That was 68%. 58% acquiring and retaining top talent. 58% reducing overstaffing, and 45% resource pooling. So these are all issues that are real issues that they're trying to solve for day in and day out. Universal Banker has been a hot topic, but we see in the surveys we've done and the banks certainly that I talk to, not just here in the U.S. but globally, that have the similar concept of multi-skilled roles or universal bankers, are often struggling with the deployment around this role. And analytics can help around how you deploy it. Analytics can help in even defining things like talent acquisition around the universal deployment, training and certifications, career pathing, the processes around the role itself and how they interact with clients and the technology and the systems. But the goal around this, right, the intention is you're going to improve service to customers, improve revenue to the organization, build greater flexibility within your workforce. This was from our last year's survey. I know when I work with clients and talk to other banks around how they're approaching allocation of their sales staff, their sales resources, it's often a fairly simplistic approach. And even in some very sophisticated organizations, it can be a simplistic approach where they just look at numbers of households and a kind of a portfolio breakdown, and then they apply a sales goal to it, and they say, well, this is how many bankers we should have. in order to meet these goals. So what I encourage is going deeper in this. And I think some of the obstacles is the data is a little harder to get to on this side of the business. So the roles, the activity is not as tracked as other parts if you think about the service side. And there are things that from a leadership perspective that need to be dealt with. And it's not just, you come up with a formula and it's going to happen. Here's some additional root causes of misalignment. So inaccurate forecasting of demand is one of them. Our view is there's a necessary requirement to really take a holistic approach to forecasting demand. So it should start, and we start on the sales side of the business. So understanding how do you truly meet customer needs, their financial needs, and let's understand what it takes to do that, what the activities are involved in that, and let's go to the effort of getting the data, identifying what the data is, the data sources, so that we can truly start to look at what the demand is there. I think we also need to recognize the messiness of the data. But if you can embrace that and understand what that is, you can work back from that data and provide better alignment, better resourcing that's aligned to what customers really need.
So what I thought I'd do is also then kind of give you some keys to success as to how does it really work. So the first one is really a test and learn. A lot of times ideas sound really cool, but I don't know, as you look at Apple Pay, how many of them are actually rolled out to an individual branch level? We've used that term a couple times, but I would say test and learn really kind of plays a big part is when you're in proof of concept and you're really kind of getting a concept to really work is where that plays into place versus when you go pilot, you're saying, okay, is this something I can actually deploy or roll out into more branches and so forth. This is a painful lesson that I'm sure hopefully you've all learned this as well, is making sure that the branch team incentives are aligned with any kind of technology rollout. A lot of times they feel like you're taking their jobs away from them. If they don't understand why you're doing something, you'll never get the success. And if they're not part of that by it being part of their incentives, whether it's a hard incentive or a team goal or individual goal, it's something you have to have in there. The next two bullet points to me are also pretty crucial and they kind of tie together. So as you have new technology, your sales team, really as you're doing your needs-based conversation with a client or a customer or client, you really have to make sure that you're incorporating, at least toward the end, how do you use these tools, and also then having an area where you can actually demo it or educate a customer is obviously an added benefit. So
these banks they're not adding new roles; they're taking existing roles and they're repurposing those or adding an additional responsibility. You need to look at and analyze your workforce and market opportunities. So again, thinking about the sales opportunities and how do you align those together, optimizing the resource allocation, reducing operating expenses, increasing revenues with the resource alignment, and then digital education for your staff. What we're just talking about, kind of a digital first strategy. You see some of the expertise that we illustrated there. So looking at the goals by branch, and then just evolving your staffing beyond just traditional sales and service and truly thinking holistically in an omni-channel way.
So with that, we will conclude today's program. On behalf of the Consumer Bankers Association, thank you to our speakers.